I love when the markets get things wrong in regards to the macro economy because that's what opens the door of opportunity to the individual investor. Oftentimes, when the market is convinced of something that's not true about the economy, they'll just sell down great companies at great valuations for the sake of selling them down because they're fearful of a recession or they're fearful of inflation. Yet, if you're savvy enough to recognize that the markets are wrong in that thinking, you can scoop up tremendous buying opportunities and make life-changing money. Just to give you a couple examples, you guys know I've been buying a company recently called Fluence Energy, ticker symbol FLNC. Originally, this stock fell because they cut their guidance by $600 million for 2025, but still, they're going to be growing revenues at 26% year over year. And in the years that are to come, they're going to grow revenues at 30% plus. And over the past few trading days, I've been able to buy more stock in Fluence Energy for basically its cash value. That's insane. This company has insiders that have been buying their own stock like crazy. Another very, very good sign. This is in an industry that has massive tailwinds, recession or not. Our country, the globe needs more power. Fluence Energy is focused on battery energy storage systems. Heck yeah, I want to buy more Fluence Energy. I've been buying Fluence Energy, but if the market wants to keep selling this thing down, I'm going to keep buying it. I have no problem with that because I realize I'm down short term on my buys, but man, I get to buy more of a company that I love for an even cheaper valuation. What's not to like there? Also, CleanSpark today had a great day, up 10%. Another company, another example of the market selling down a stock to the point where it's trading at its net asset value. The future for CleanSpark is very, very bright, especially if a strategic Bitcoin reserve is really announced. CleanSpark is profitably mining Bitcoin. They can acquire Bitcoin for $40,000 to $50,000, while everybody else has to pay $90,000 for it because they're a Bitcoin mining company. Heck yeah. If the market wants to trade it for its net asset value, I want shares. Give me as many shares as I can possibly get my hands on. Now, another problem retail investors seem to run into is they always say, I wish I had more cash to buy. But that's something that's the case no matter what. I've been in this game long enough to know no matter how much cash you have, you're always going to say, I wish I had more cash to buy more stock. Just do what you can with what you have at your disposal. A little can go a long ways when you're buying companies that are growing their revenues like crazy, that are growing their profits like crazy, that are in industries that have massive tailwinds, and that are trading for their net asset value. Give me. And then lastly, another company I've been buying, One Stop Systems, focused on taking the remote data center to the edge, mobilizing and ruggedizing it. They're into edge AI big time. If edge AI explodes like I think it will, One Stop Systems, this company has a legitimate chance of 100xing my money. Better yet, this is a company that's going to be profitable this year. Last quarter, they had positive cash flows from operations, and they're going to do revenues of $60 to $70 million over the coming 12 months, if not more than that. And the market cap of this company is $60 million. If the market wants to keep selling me this stock at an even cheaper and an even lower valuation day after day after day after day because they're worried about a recession, give me more shares. Give me more shares because this is another company, regardless of recession. If AI goes where we think it will go, this is going to be this company's going to benefit in a big way. Right now, the markets are focused too much on what has propelled the economy in the past, and they're not focused enough on what's going to propel the economy in the future. What I mean by that is market participants are basically saying, as a result of Trump cutting fiscal spending, the economy is going to fall. But they fail to mention that private sector investment has exploded under Trump's second presidency already. And that private sector investment didn't exist prior to Trump 2.0, so it more than likely will offset any and all fiscal stimulus that we're doing away with. Just the other day, I have this written in my notes somewhere. $1.3 trillion of new investment in our country since the election in the private sector. $1.3 trillion. Most of that is going to AI. And AI, the way AI succeeds is it's at the edge where latency is as low as it's as little as possible. Because latency is a poison to what AI is trying to accomplish. I've said this before, but a lot of the AI hype has been around the data center. Data centers have existed for years and years and years. We've rebranded data centers or big data into the buzzword AI. Real AI happens at the edge, and that's what One Stop Systems does. I cannot get my hands on enough shares of One Stop Systems. If the market wants to keep selling it to me for this cheap of a valuation, I'm going to keep buying it. I'm happy to keep buying. Now, to focus on what the markets are getting wrong, let's start with this. The Atlanta Fed's GDP estimate for Q1 growth, which right now is estimated to be negative 2.8%. The markets, this put markets in a frenzy. I mean, the markets on Monday and Tuesday were down a bunch because supposedly our economy is entering some sort of recession during a time period where Trump is introducing new tariffs, which might cause inflation to go higher. Most people didn't do the additional research. They stopped their research there. Most people might not know that there's more research to do, but why did the Atlanta Fed's GDP estimate fall for Q1? Well, it's because of this. This is a breakdown of all of the different pieces that go into the Atlanta Fed's GDP estimate model. You'll see one thing at the bottom here, this massive blue horizontal line. This is an outlier. And you know what it shows? It shows net exports that decreased almost 30% in the quarter. 30% in the quarter. So this means that imports rose significantly faster than exports during the quarter. And well, this also shows it. Previously, goods imports had a negative, I have this in my notes here too, negative 41 basis point impact to the Atlanta Fed's GDP model. During the most recent update, goods imports had a 3.7%, negative 3.7% impact to this GDP estimate. Why is that? I've mentioned this before too. Well, imports subtract from GDP and exports add to GDP. Why did imports absolutely explode in December and January? Well, it's because businesses wanted to front run any sort of tariffs that they thought might be implemented from Trump. And as a result of that, we have a one-time outlier in the GDP estimate data that shows GDP forecasted to shrink 2.8% in Q1 based on imports growing and exports staying flat. Is that really indicative of a structural problem in our economy when it comes to our economic growth? No. Not at all. But again, if the markets want to sell off really, really strong companies and make their valuations even more attractive, I'm all for it. I'm not going to lose my mind over it. Bring it on, man. Bring it on. Now, better yet, another thing that the markets are getting wrong when it comes to tariffs is that they supposedly cause a bunch of consumer price inflation. When in reality, we have data we can go back and look at. In 2018 and in 2019, when Trump introduced his first round of tariff increases, inflation was at or below the Fed's 2.0% target and actually trended down because companies don't have pricing power because of the way our economy is set up that encourages competition. If you have two different companies and one of those companies chooses to pass on the extra cost of the tariff to the consumer, and the other company doesn't pass on that cost to the consumer and they choose to eat it in their profit margins instead, well, that business is going to get all of the business that the other company did because that consumer is not going to pay the additional price. They're going to go to the company that's keeping the price the same, which makes it really hard for corporations in the United States of America to pass on one-time cost increases to the consumer. It's competition. Now, don't hear what I'm not saying. Of course, there's going to be inflation, but the inflation is mostly going to impact the producer and the exporter. The consumer, at the end of the day, never really feels much impact from tariff increases. Our budget, a long, long time ago, most of our government income came from tariffs, yet inflation was never a problem back then. So why would it be a problem now? And any additional cost that does get passed on to the consumer is going to be a one-time small hit to prices. It's not going to be an embedded inflation problem that recurs and happens year over year over year and laps itself year over year over year. It's a one-time hit. The markets, I think, are completely misguided when it comes to tariffs and inflation right now. Now, moving on, tariffs and inflation are one side of the coin, but the other side of the coin that the markets are worried about right now is the consumer. Consumer demand has been weak, at least in the data we've gotten for the month of January, which I'll show you in a little bit is very meaningful that we're just looking at January's data right now. When we start to get February's data, more than likely the consumer is going to show that it is still in a strong place and our economy is still in a strong place. You see, during January, this chart here shows it, the blue line, there was an uptick in the personal savings rate. This is not because incomes just absolutely exploded. It's because incomes went up, but also consumption fell. That's a dichotomy that very rarely happens. Usually, if consumers are making more money, they're going to spend more money. So we have to look at that aberration in the data. What might have caused that? Well, I can tell you that in January, and a lot of you will remember this, we had our coldest January since 1988. We had widespread record-breaking cold in the month of January. We can look at Redbook retail sales data, and you'll actually see this, that in January, retail sales were weak. 4% growth, 4.5% growth, 4.9% growth. But when we entered February and the cold weather subsided, well, retail sales, retail spending resumed its growth. 5.7%, 5.3%, 6.3%, 6.2%. And the most recent data that we got on March 4th, so yesterday, showed 6.6% growth in retail sales. Again, something the markets are completely misguided and are misunderstanding. They don't realize that January's data, which is what the markets are concerned about right now, was impacted by cold weather. Yes, believe it or not, freezing temperatures make people not spend as much money because they stay indoors, which I'm sure most of you did as well. So as we enter the months of February and March, consumer spending should resume its growth, should show its strength has continued, and, well, I can almost guarantee imports are going to start to fall off a cliff because corporations are no longer front-running tariffs that might happen. The tariffs are already here. The front-running is over. Trump's been inaugurated. He's our president. So when we get February and March's data, imports are also going to fall, which will equalize this trade balance and probably reverse a lot of this negative 2.8% GDP growth estimate. Just to show you the outlier on the consumption side of things, I showed you the trade outlier. Look at this. Personal savings grew 32.2% in January. Because of the cold weather, you'll see incomes actually went up. Personal incomes increased 0.9%, but personal consumption fell 0.2% because of that colder weather, resulting in personal savings increasing by 32.2%. Now, back to the imports side of things, you can see that imports, and this is the first data we've gotten for the month of February. Like I said, imports are contracting, down 0.2%. in the month of February. This is going to start to offset January's data that's forced this GDP estimate to go as low as negative 2.8%. And when that happens, and when the consumer starts to show that it's still strong in February and in March's data, I still expect at the end of the day, GDP growth in Q1 will be 1 to 1.5%. And right now, the markets don't realize this. And man, that's the opportunity that I am so incredibly excited about right now. You don't get these sorts of opportunities every day. But right now, man, I'm trying to plow as much money as I can into the markets, into companies that I love. Now it seems like a good time to mention the membership. I mean, I give you my buy and sell alerts. I have a company I've been buying recently that I haven't posted the public YouTube channel yet, but it's coming, maybe in a couple weeks. If you want early access to that sort of stuff and extra access to my brain and breakdowns like this, check out that membership. Hit the Patreon link in the pinned comment down below. It's one of the cheapest memberships on YouTube. It helps to support me and my stock market buying addiction. You get to support that, so that's another good thing. Just check it out. If you don't find value in it, I have a 100% refund policy, so zero risk to you. And we actually just got data on inflation today via the S&P Global U.S. Services PMI, and they say, however, efforts to pass on higher input costs to clients were somewhat limited by competitive pressures, weak market demand, and market oversupply, aka producers are struggling to pass on cost increases to the consumer. Interesting. Now, don't get me wrong. There are plenty of short-term uncertainties when it comes to Trump 2.0. I mean, the stock market is an absolute roller coaster. We're still dealing with inflationary consequences from 4 years ago, printing too much money to try and stimulate the economy. There's a lot going on here. There are things to be concerned about. But if we think that, Trump's pro-business policies won't start to outweigh these short-term uncertainties, I don't know if I agree with you. Trump's pro-business policies should boost long-term confidence more than this short-term uncertainty is hurting the markets. And if you go back, we actually saw this same playbook unfold in Trump's first presidency. At the end of the day, business optimism increased and business confidence increased, and likewise for the consumer. And I think that's exactly what's going to happen again. Now, yes, over the last 4 years, a lot of our GDP growth probably came from additional excessive fiscal spending, fiscal stimulus. I agree with that. Like I mentioned, we still have inflationary pressures from 4 years ago that are hitting our economy. That should tell you that, there was excessive fiscal stimulus. But again, Trump's playbook is totally different. He says we don't need this fiscal stimulus if the private sector does it for us, and we encourage private investment. And so far, that's exactly what is happening. And if we're being honest with ourselves, a lot of the fiscal stimulus over the last 4 years went to much more unproductive things than AI, which is where the money's going today in the private sector. Under Biden's presidency, we had a lot of money go to electric vehicles and green energy, not really productivity enhancing ventures. AI, on the other hand, that's something that will benefit the economy, businesses and consumers alike, for years and years and years to come. And to wrap this video up, if you really think Donald Trump doesn't care about the stock market, you are sorely mistaken. At the end of the day, Trump will always care about the stock market, and that's probably why you've seen him start to walk back some of his tariff talk. He realizes that, a lot of my policies are going to hurt the stock market short term, but that sets me up to look good at the end of the day if, in turn, I make the stock market rise instead of fall, if I stop that crash from happening. It's exactly what's going on right now. So not only do we have a Fed put, a Federal Reserve that's willing and able to stop a recession in its tracks if it does pop up on the radar by cutting interest rates. Remember, interest rates are back to 5%. We're at a point where we can cut them if we have to. If interest rates didn't rise, we'd be at near zero interest rates still. And to stimulate the economy, you'd have to cut interest rates into negative territory, which we definitely don't want. That gets pretty complicated. But I don't know. Suffice it all to say, I keep selling down the stock market short term. I'm extremely optimistic about things. I really think the markets are mistaken right now. And I'm going to keep taking advantage of that. If that means my stocks are going to keep falling short term, so be it. This could last months longer, and I'd just be thrilled. Now, if you guys are new here, returning, not yet subscribed, please subscribe down below. I love seeing all the new faces pop into the YouTube channel. We're quickly approaching 40,000 subscribers. I can't thank you guys enough. Don't forget to check out that membership by hitting the Patreon link in the pinned comment. You'll be able to join the Discord server as well. Without further ado, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.